your boy Crypto Blood, and welcome to another episode of My 2 Cents. This morning we're looking at some more Fed balance sheet news. Looks like they've been expanding the balance sheet, and this is crazy. They've been expanding it faster than they had in 2008. We're going to look at some of this. We've got something on our hands, and I just want to keep you guys up to date as things change when it comes to the Fed and the Federal Reserve balance sheet and the repo market. So we're going to look at how they're quietly increasing their repo rate. We got some shocking articles, or maybe not shocking to me at least. But before we start, if you guys find these types of videos informative, make sure you like, share, and subscribe, and click that bell to receive more videos like this. So this is out of Barron's, guys. The Fed has quietly been increasing the size of its repo interventions, but can it fix the problem? No, it cannot. The Barron's article says that the Fed has been intervening more aggressively in money markets as it attempts to keep interest rates from rising around the end of the year. This is very important. On Monday, the central bank again increased the amount of short-term cash loans it plans to offer banks to ensure U.S. interest rates remain stable later this month. It now plans to offer $25 billion in cash loans for the 28-day period ending January 6th. That is up $15 billion previously. Last week, it increased the size of the 42-day facilities for a period ending January 13th by $10 billion as well. This is this is only one more example of what we have going on here and how this is steadily getting worse by the day. But they're having the short-term intended response by the markets. If you guys didn't know, the Dow Jones closed a whopping 1.2% up Friday, 332 points. Dow Jones ends at 28,015 bucks. And buy the dip, right? That's what. Don't fight the Fed. See, we saw the drop, and before we even tested the previous support area, the markets bid it up and closed the week strong. As I told you guys, this is going to continue to happen. Meanwhile, ironically enough, just about by the same amount in the opposite direction, gold down 1.25% for the close of Friday's trading to $14,600. And I think we'll continue to see, this head lower. I don't see this changing at all. I think we're going to continue to see gold get slammed here as these firms look for yield. They have to find it somewhere. Gold, remember, is not a productive asset. And this money that you see in the COMEX, it's primarily the Wall Street and their buddies around the globe. So this is how we have to treat this. So, this is the price of gold, maybe not the gold price. I know many understand what I'm talking about, but it's just good to keep an eye out on what's going on in the COMEX when it comes to gold. So again, down just about the same amount in the opposite direction, percentage wise, 1.25% on Friday. But I want to show you really quickly out of Zero Hedge, the $1 trillion per month hole that the Fed is digging themselves into. It says in the 2 months since the repo market blew up, the Fed has been making repo open market operation purchases, or POMO, at the rate of $1.2 trillion per month. So just to put that into context, that is almost the amount of student loan debt this country has in its entirety a month. That's how big this operation is. I think that should really put it into perspective for you. It says below is the monthly rate of Fed open market purchases since 2000. In the era of QE and ample reserves, the Fed has not touched open market operations for more than 10 years before 2019. Prior to that, the highest rate of open market operations we saw in history was roughly $300 billion per month, briefly after the September 11 attacks, with long-term averages of around $50 billion a month. To say the current rate of $1.2 trillion is unprecedented would be an understatement. Look at this, people. Absolutely insane. There is something critical going on. You guys need to prepare. And I'm not doom and glooming. I'm just giving you the obvious. I'm giving you the facts here. The planned QE unwinding has hit a brick wall, and the Fed balance sheet is now expanding at a rate matched only briefly by QE1 and faster than QE2 and 3. So we can essentially call this QE4. Is that right? Yes, this is QE4. To answer the question, we must look at how monetary policy has evolved since the financial crisis. So again, it just kind of goes through, how we operated, or the Federal Reserve operated on a month-to-month basis prior to 2008's crisis. So, they had a total reserve of only $50 billion, or actually less than that. There were no excess reserves at that time. Interest on excess reserves was 0%. This is the baseline. This is what we're going to be comparing everything since then. So let's take a look at 2008 through 2019, which has been the last 10, 11 years. Basically, I think the start of the next Great Depression. Depressions don't happen overnight. It's a process, and it's an ebb and flow. It's a cycle. Okay. So guess what? Total reserves, large, in the trillions. Excess reserves, in the trillions. Interest on excess reserves, positive at around Fed funds rate. And the banks, well, regulations are strict and risk tolerance is low, yet we're still printing money like it's 1995. Treasury Department no longer actively managing its cash flows. Its activities directly affect total reserve levels. And it's going on to talk about what is going to happen in 2020 and beyond. Combination of QE unwinding, strict banking regulations, and a concentration of reserves in a handful of banks have once again made reserves scarce, which means a rate floor is no longer effective at managing against rate rises. This was painfully obvious in December of 2018 and September of 2019. Thus far, the Fed has chosen their pre-2008 strategy of temporary open market operations to manage rates in this new scarce reserves environment. So I think this article, and then this is the reason why I selected this for this morning, it really illustrates what the hell is going on right now. Just the magnitude of the situation. It's dire, people. It really is dire. But the next article I want us to take a look at is one out of American Free Press, which was this article written by Ron Paul, and it says the mother of all bubbles about to burst. Well, I'm pretty sure we've got to be very soon. Ron Paul says when the Federal Reserve began pumping billions of dollars a day into the repurchasing markets, the market banks used to make short-term loans to each other with. In September, they said this would only be necessary for a few weeks. Yet, last Wednesday, almost 2 months later, Federal Reserve initial intervention from the New York Federal Reserve pumped $62.5 billion into the repo market. So kind of just going over the same thing, but what I want to highlight here is what he says about what actually may have caused this whole situation. He says one cause of the repo market's sudden cash shortage was the large amount of debt instruments issued by the Treasury Department in late summer and early fall. So banks used resources they would normally devote to private sector lending and overnight loans to purchase these Treasury securities. So this scenario will likely keep recurring as the Treasury Department will have to continue issuing new debt instruments to finance continuing increases in government spending. So essentially, Dr. Ron Paul is saying that this is not stopping. And I mean, we know this. This is the end. Now, how long they can continue to do this is another question. That's something that I personally don't know, and I don't think anyone does. There are too many moving parts to really know when the end date for this is. But you can kind of just understand in a general sense, this is towards the end of this thing. Like if you're flying in a plane and you start your descent path, you don't know exactly down to the minute or the second when those tires hit the runway, but in a general way, okay, we're starting our descent, we're heading toward the direction of landing. So that's how I feel about this market right now. I couldn't tell you the exact second, or I should say the exact day that the markets will buckle under its own pressure, but in a general bird's eye view, we are at the tail end of things. According to Mike Pinto, the Fed is panicking in an effort to prevent economic trouble much worse than occurred in 2008. So he says it's not just QE, he says. It's QE on steroids because everybody knows that this QE is permanent, just like any banana republic would do or has done in the past. Congress will not cut spending until either a critical mass of Americans demand they do so, or there is a major economic crisis. In the event of a crisis, Congress will try to avoid directly cutting spending, instead letting the Federal Reserve do its dirty work via currency depreciation. Absolutely. The next economic slowdown, they're not going to cut. Why would they? We're supposedly not in one now. So if we're printing this much, injecting this much cash into the markets now, we'll be damned if they decide to become monetarily responsible and start turning the spigot off. Not going to happen, people. Not going to happen. So I just wanted to give you that highlight. I'll drop the link to this article Ron Paul wrote in the comments section below. And the last article out of Zero Hedge. Macro Hive says when we fall back into recession, and real QE returns, watch out. So essentially what Macro is saying, Macro Hive, they're saying that, we know that they're pumping billions in weekly. We can see that. So many people have reported on that. But what they're saying and asking the question of, is it too little or too much? Basically, is the Federal Reserve too late or too early with this money printing and injection into the repo markets? They say the true test lies still in the weeks around the end of the year. And they go on and talk about how they're really doing two operations right now. They're buying T-bills, which I talked about in previous videos. The difference, T-bills are even shorter term. We're talking weeks. And they're doing their whole purchase of longer term assets or T-bonds, right? So it's kind of like two operations combined in one. And, their primary question is what comes next in 2020. Macro Hive is quick to point out that the Federal Reserve has imperfect control over its liabilities, so we should not assume one-for-one relationships when it comes to their asset purchases and the expansion of those excess reserves. As you can see in this chart here, liabilities versus assets on the Federal Reserve balance sheet, total reserves have increased, but the TGA grew much more in total. In fact, the first week post 9/11 was the week that led to the reserve shortfall repo spike as TGA expanded. And TGA just standing for Treasury General Account, guys. So they're saying this is unprecedented a time we're in when it comes to what the Fed is doing in the repo market. So what their prediction for 2020 is that the curve could steepen. So they think the curve is going to actually steepen and further complicate matters. If the Fed only buys T-bills, they say they may end up enriching enough to encourage money market funds to start using the RPR again, which would drain reserves from the banks. If that were to occur, the Fed would likely need to start buying out the curve and buy less T-bills. At that point, they would need to stop their lying that their purchases are not QE. It would clearly be QE. This would favor staying with steepeners outright and or on a forward basis as the front part of the curve, the 2-year, for example, would start to get depressed by this QE. So, wow. Basically, what both of these zero hedge articles are telling us is essentially 2020 is kind of like the end of the game, because at that point, the Fed would have to show their hand. I mean, they're already showing their hand, people. They really are. But it will really affect the shorter part of the curve by 2020. And at that point, everyone will know for sure this is just QE4. Now, but what does that mean, though? Because if the markets, meaning the equity markets, and this is a perverse system we're in now, this is not a normal market environment. So do we continue to rise because QE is a known thing at that point? It's free money. That's more money to push into the markets at the top. And who's at the top? The banks in Wall Street. And what are they going to do with that free money? They're going to go out and buy stocks and bonds. So it is a very complicated scenario, and don't try to pick the top. Use this opportunity really to start preparing whatever your strategy is. I can't, give you that advice, but whatever your strategy has been over the last 10 years that has not come to pass, start accelerating that strategy and being more aggressive with it, because the end of this nonsense is very, very close. But that's pretty much it for today, ladies and gents. That's my 2 cents. If you found this video informative, make sure you guys like, share, and subscribe, and click that bell to receive more videos like this. I'm out of here. Holla.